Good morning and welcome to this Wednesday, March 22nd, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it's Fed Day. That's probably the biggest thing going on right now with stocks. So we'll see what happens at 2 o'clock this afternoon. That's when the Fed will announce their latest Fed funds rate decision. Rates going up, rates coming down, rates staying the same. Well, most everyone would agree rates are probably going up a quarter basis point. I still think there's a chance that they do nothing. I'm not in the majority. I'm clearly in the minority. I think it would be the wise move, but we'll see what happens. I think the big shocker would be if they decided to step up 50 basis points, especially with everything going on with banks over the last week or so. I don't think we're going to see that, but that would kind of throw off everything. I think at that point, it could be another August of 2022 scenario back at Jackson Hole when the Fed kind of went out of character and started talking about, really just editorializing instead of just giving their opinion and what they were doing with interest rates, blah, blah, blah. That was the meeting where Jay Powell said that there was more pain ahead, referring to the stock market. And that is not really their job. And I thought it was inappropriate. Still think that that was the reason why we ended up going down one more time, put in another low in early October. And since then, we've been rallying off of that. And honestly, I think we're about to explode higher. We'll see what happens later today, but I've been saying, I said it even at the beginning of the year, I thought February, second half of February and into March would be the one time we might pull back one last time before we had a very, very big rally over the balance of 2023. And honestly, I think it's getting ready to start. And we'll go over some of that and the reason why in just a minute. Let me go ahead and jump into the daily market recap from yesterday. So the Dow Jones Industrial Average yesterday up 316 points. That was almost 1%. S&P 500 up 51. That was 1.3%. NASDAQ up 185 points, 1.58%. It actually cleared its earlier high that we saw in early March. You can see the, I think this helps you to kind of see rotation that I've been talking about. You can see it obviously by just using ratios, the QQQ versus the spider, that sort of thing. But if you just look at this chart, you can see how we took out the early April high. Look at the S&P. Not quite up to that early March high. And then same thing with the Dow Jones. Rallying, but not really near that earlier March high. So things are definitely changing. Money is rotating into growth. I mean, that part has been very clear in the first quarter of 2023. Money is rotating into growth. Just think about it from a common sense perspective. Would you want to get into growth stocks right before a big recession? Because everybody's talking about a recession and how the Fed's been raising rates. Folks, rates were down near zero. They couldn't do anything really but go up. We're getting back to an area where I think it's important that rates level off and start to go back down. I think if rates keep going up from this level for an extended period of time, then yes, the stock market's going to have problems. But historically, where we sit right now on the Fed funds rate is not a bad level. It's not, exorbitant borrowing costs for companies. It's not a bad thing. So, for a while we were wondering, well, when rates were at zero, the Fed has no ammunition if they need something. Can't take rates any lower. We're going to go below zero? Probably not. So I think things are starting to normalize after the craziness that we've been through really over the last 15 years, dating back to the financial crisis. But more importantly, and more specifically, the pandemic back in 2020. Everything's kind of been crazy over the last 2 or 3 years, not just in terms of the massive run we saw up in the stock market in 2020 and 2021, but the crazy rotation, the sudden surge in inflation, I mean, all these things, in my opinion, have stemmed from the pandemic. We had the crash in 2020, remember? It's only 3 years ago. S&P was down 35% in 4 weeks. And then we had that massive rally off of it. It's been crazy. The rotation's been crazy. I think we're starting to get more into a normal market. I thought it was going to take place second half of 2022. I think it's been delayed, but I believe it's here. Mid caps up 1.8% yesterday. That was up 44 points. Small caps up 1 2/3%. That was up 19 points. So everything's starting to turn back up again. I do want to point out that both the NASDAQ and the S&P 500 had AD lines set a new all-time high yesterday. Again, AD lines moving to all-time highs right before a major recession. Yeah, I'm not getting it. I don't think that's what we're going to have. Energy led the sectors yesterday. Energy had been very weak, coming back up, though, getting back close to where we had broken down from. The 20-day moving average is going to be pretty important because that's right where we had prior support that we lost earlier in March. So now we're coming back up and testing that. If we can get through 82 or 83, I think that would be a really, really good sign, not just for energy, but I think it would be another bullish signal in the market. Discretionary, I think this downtrend line now is broken. We went back up through both moving averages yesterday. Discretionary rose 2.76%, up $4, back above the 145 level. Financials finally getting a reasonable day, up 2.5% yesterday, back to the 32 area. Communication services up 2%, breaking out above its most recent highs. I've said before, I think communication services will be one of the better performing sectors for the year. And we got off to a great start in January. And after pulling back, I think we're now beginning to resume that uptrend. Utilities, yesterday was a bad day. March is normally a good month for utilities. I think that this is probably the time. If we go down one more time, and I don't know what's going to happen with the Fed. Everything's always so volatile. You never quite know what's going to happen in the short term. But if we do go down one more time, and there is a negative divergence on the 60-minute chart of both the NASDAQ and on semiconductors, the key cog behind the NASDAQ. If we do pull back, I think utilities might get a little bit of a boost. But personally, I think its March run is over. I think it's going to start to take a back seat to some of the other areas once this market gets going. And I believe we are going to get going. 10-year Treasury yield. Let's get the latest here this morning. Currently, we're at 3.634%. That's up almost 3 basis points. Futures, by the way, we've got Dow up slightly, S&P and NASDAQ down slightly, so a little bifurcation there. Crude oil prices are flat right now, still just below $70 a barrel. And like I said, this 10-year Treasury yield now up to 3.63%. What's going to happen with the Fed today? So obviously the stocks are going to be impacted, but so is the bond market. The bond market's going to be listening closely, not just to what they do today. Everybody, like I said, expecting the 25 basis point hike. I think that's built in. I don't think the market's worried about if it's a 25 basis point hike. I think if they decide not to hike, I think the market explodes to the upside. I think if they decide to raise 50, I'm not sure what's going to happen, but it's probably not going to be good. And I just can't imagine they're going to do that in the face of everything going on with the banks. But again, I don't really trust this Fed. So let's see what they have to say at 2:00 today. But I can tell you right now, I'm gearing up for a move to the upside in stocks. Next thing I wanted to go over was just taking a look at the S&P 500. So again, we did get back up through the 20-day. I've been mentioning recently, that's the first step. Get through the 20-day. For the 6th time in the last 7 days, the S&P 500 closed above its open. 6 out of 7. We had kind of fallen apart. When we got down here, the 5-day moving average of the equity-only put-call ratio, which is one of my favorite short-term sentiment signals, had reached about 0.85, the 5-day moving average. Anytime that gets up above 0.80, you look for a market bottom. It's uncanny. If you look back over history, how successful that signal has been. And sure enough, once again, we rally back off of it. This time, I'm not so sure we're going to stop. We'll see what happens again with the Fed. I think today, tomorrow is going to be kind of the wild card. But I think once we get past this week, I think the market's going to start looking ahead to earnings, and I think we're going to explode to the upside. I think we have a big, big, big rally coming. The NASDAQ 100. So we're almost breaking out above the February high. So let's go back and look at that S&P and look at where we are. Oops. Let's look at where we are now versus the February high. We still got a ways to go. We got almost 200 points, 4 or 5%. The NASDAQ 100 maybe has a half of 1%. So let's see here. So we were at 12,803 and now we're at 12,741. We need 62 points. That is just about a half of 1%. Hold on one second. Thank you. So we've only got about half of 1% to get back up to that February high. Pretty impressive considering that the overall market's been down. And again, I'll challenge you. Tell me why growth stocks are outperforming. How about this chart? IWF, IWD. This is large cap growth versus large cap value. And I'm just going to put that in as a line chart. And down here below, I'm going to get rid of the PPO and we're going to set up correlation. And we'll go back 5 years. Don't really need to volume. So first of all, look at what's happening here in 2023. We are exploding to the upside. Growth over value. Growth over value. Big recession ahead. Why in the heck would you be pouring into growth stocks ahead of a recession? Why? Yeah, I can't come up with anything either. No need, no reason. You would be turning defensive in a big way. Every recession that we've had, if you go back and you look, money rotates to defense, not offense. You look at the correlation, IWF, so the direction of this ratio versus the direction of the S&P 500. Most of our readings are above zero. In other words, we have very positive correlation. If you look at above 0.5, that's very strong positive correlation. We have a lot of readings in that area. How about strong inverse or negative correlation below minus 0.50? We've been down there. It's happened, but it doesn't happen nearly as often, number one. And number two, when it does happen, we reverse very quickly back to the upside. Look at what's happening right now. The S&P was going down recently, right? The IWF, IWD going up. That's that inverse correlation. That's why we reached minus 0.5. So what I've said is one of two things are going to happen. Number one, either the bottom's going to fall out of growth stocks and all of a sudden we're going to just tumble back down, or the S&P 500 is going to rally. Yesterday, we moved back up through the 20-day. And I think with all of the signals I'm showing, I think this is just starting to the upside. So I'm looking for a big rally, not only in this ratio, but in the S&P 500. Now, here's the chart of the day. This is what I just sent out in our EB Digest to all of our, all the folks in our community. And I need to preface that first with another couple of charts. So I want to show you first. This was back in Market Vision 2022, held on January 8th, 2022. I pulled up, anyone who was there can vouch for me. I said the biggest issue going into 2022 was that we were just starting to turn up. on this 253-day moving average of the equity only put call ratio. And you might say, well, isn't that a lagging indicator? That's a year. Well, it's the Freightliner of sentiment, the way I look at it. It's not the speedboat. The 5-day moving average is a speedboat. You know, it can turn on a dime. It goes down, or the 5-day moving average goes up. It marks market bottoms and then comes back down again. And so it's the speedboat. This is the Freightliner. This doesn't turn around very easily. It takes a while. And when it turns, you need to pay attention. When I pointed this out at the beginning of 2022, I said this was just moving up from the most bullish readings we had ever seen. Look at, this is a 1-year average of the equity only put call ratio down at about 0.46, 0.45, 0.46. If I show you the CPCE, and let's go back, well, let's go ahead and pull this up first. But let's go back 10 years, 15 years. And look at this. These are all daily readings. But I want you to look at how many times we went below 0.5 over 10 years. I mean, we did it occasionally, but very rarely. Rarely did we even have a single day reading below 0.5. The lower you go, by the way, the more the ratio skews toward calls versus puts. That means traders are getting incredibly bullish about the market when you start getting readings way down in here, okay? Look at 2020 with after the pandemic, and we kept going up, up, up. Remember, we went up 115% in 22 months, the biggest 22-month run since back in the 1930s. Everybody got so bullish because the market just kept going up. It was an ATM machine. That was a problem because you get to the point where you get the last buyer and then there's no one else to buy. At the very beginning of 2022, money was rotating into defense. I talked about that at Market Vision 2022. Why, if the market's going to keep going higher, would Wall Street be moving into defense? It was another signal the market was topping. But look at all these readings down here, down below 0.4. We had many, many days below 0.4. It was crazy, right? And so when we finally started to turn up, I said, this is not good. Look at when we turned up here. The next 2 years, not good. We turned up here. The next year, year and a half, I don't know, maybe 15 months, pretty much just sideways action. We turned up here. We did almost nothing for a year and a half, 2 years. Then here we had a little bit of Freightliner trying to be a speedboat with everything going on, trade war, the pandemic, the rally in between, and then, of course, the huge rally in 2021. But right here, just as we did Market Vision 2022, we started to see this moving up. And look what happened. I mean, I don't make this stuff up. When this is going up, when we are resetting sentiment back to the upside, nothing good happens in the stock market. But when we roll over, that's when we have our biggest advances historically. Because we get too bearish, we run out of sellers. Just go out to your local, watering hole, wherever you like to hang out, and ask people about the market. What do you think about the market? I love it because this is what I do. So I like going, picking friends' brains, and everybody's like, oh man, the market's horrible. It's awful. We have no chance. This is going to get really ugly. That's the general consensus. And it's so funny because 15 months ago, you couldn't find anybody who was bearish. That's how sentiment works. Sentiment, when you get to extremes, changes direction. It's a contrarian indicator, and it works beautifully. Now, you might be looking at this chart and say, yeah, but Tom, it's still going up. It hasn't rolled over. Well, I want to show you something. Let's go back and let's take a look. Look at these individual readings back in November and December. Look at how crazy crazy bearish we got. These were readings we had never seen. The financial crisis back in 2008, when the market was falling apart, Bear Stearns gone. We were worried about the whole entire financial system collapsing. The biggest reading we ever saw was 1.35%. And actually, I think that was earlier in the year. I think if we go back one more year, it was back in like March of 2007, 2008. I mean, right there. That's that 1.35 reading. These were all occurring when the stock market was absolutely falling apart. These readings were all coming in when the market was going up. If you look back, every one of these readings, these high readings, are occurring when we're either in a bear market or making a very significant breakdown and the market's panicking. These readings were coming in when the market was going up. Made no sense. So we started digging into it. I had a number of members emailing me, which I appreciate every one of you who did so, talking about different articles that were addressing what was going on in the options market. Institutions, there were many institutions out there that were hedging. They likely owned Apple, Amazon, Google, NVIDIA, Tesla, all these big names, big tech stocks or big NASDAQ stocks. And they were doing these massive amount of puts, I think, as a hedge. Well, that's not really what we're looking for in the equity only put call ratio. What we're looking for is we want to get the psyche of individual retail traders. Most institutions trade contracts on indexes or major ETFs. You don't normally see institutions going in and buying hundreds of thousands of puts on a stock. Usually doesn't happen. And so these readings were skewing. Those incredibly high readings are still skewing this right here. So what I did is I created a user-defined index and I adjusted those November and December readings down to more reasonable levels. And it was really easy to do because most of those crazy readings and most of the large amount of puts were coming in the middle of the day when there's very little option activity. And so it was really easy to spot it and remove it. And so what I did is I ran my own user-defined index on the CPCE, taking the data in 2021 and 2022 all the way up until November and December. And then I put my own readings in. And in this year, I'm putting the same readings that the CPCE has. So I'm back to using the regular numbers. And what I've come up with is this. This is the 253 days started in June, because I probably started doing these readings in June of 2021. Didn't need to go all the way back because they're the exact same. I just wanted to see when the true rolling over began, and I think first of all it began back in January, but I think this was our final move to the upside, and I think right now we're moving down. Here's an interesting part. If you look at the CPCE, and let's just look at the last. Well, let's look at the last year, or maybe even 2 years. Look at the reading we just had. Look at the reading we had in February, 0.5, maybe just a little bit below, 0.49 maybe. There's 0.5. November, some of these lows, and that's those individual spikes I was talking about that I needed to eliminate. It wasn't happening every day. And if you look at the S&P 500, some of these days, the S&P 500 had a massive up day. And it's showing a ton of puts being, more puts than calls should be showing us fear. When the S&P 500 is having a huge up day, you don't have fear. So they just made no sense. And you can see they stick out like a sore thumb. But anyway, look at these readings that we're starting to see. We're starting to move back down. Notice at the beginning of 22, we started to see some spikes before we really started to ramp up later in the year. Notice all these readings down at 0.3s, 0.4s in 2021. What happened to them in 2022? They started to fade away. Now they're starting to come back. We're just starting to roll over. This is just happening. And let me go back and show you again what happens when we roll over. When we roll over and start moving lower, it's unmistakable, folks. 101% move here over the course of less than 2 years. Here in 1 year, that was a 20% move to the upside. Here over the course of 2 years, 56% move. Here over the course of 2 years, maybe a little more than 2 years, 47% move. And here over the course of a year, this is the exception of the rule. I certainly wouldn't expect this, but 112%. The point is, when this rolls over and starts coming back down, the stock market only does one thing. It goes up. Think about it. Everybody that wants to sell, everybody that's bearish has sold. Look at all the news we've had since the middle of last year, all the bad news. What a lot of people don't realize is that when you look at the S&P 500, rates back in May of last year, the Fed funds was at 1% back here. We're now, I don't know, we've had multiple, 4.5%? Multiple 50 basis point moves. Now we're doing 25 basis point moves. Don't fight the Fed. Well, how do you explain us being at 3,900 in May at the low when the Fed funds rate was 1%? And the fact that we're at 4,000 now as the market anticipates another rate hike today. Why isn't the market going down? Distribution took place back from January to June. I can tell you why. I track distribution. I literally just sent out to our members at Earnings Beach yesterday a chart on the QQQ relative to the S&P 500. It is going straight up right now. If we ignore gaps and just look at the intraday action, the QQQ versus Spider is going straight up. Even during the S&P 500's recent decline, it's setting up, folks. We were going up at the end of 2021, but money was rotating into defense. That was our warning sign. That was our clue. We were not going to keep going higher. Now, the S&P, as it goes down, we're seeing all this money rotating into growth. I mean, I can pull up, we can see it in the QQQ Spider, but this is going to include gaps, but it's still going up. Look at this. March is going up. I'm not making this up. When the market was getting killed, if we go back 2 years, so we topped at the beginning of December. The stock market topped in the beginning of January. Money was rotating away from growth as the market topped. Now, with the S&P going down recently again, not too far from recent lows, money is rotating into growth. The big distribution took place right here. I called a bottom back in June of last year, and somehow, unbelievably, still being criticized for it, when I think we've spent 5 trading days below that June low. We've had 5 closes below that June low. All this negativity that keeps coming into the market. Now we got the financial crisis. We got the Fed raising. We got inflation. We got interest rates soaring. We got all these things. Why isn't the market going lower? Ask yourself that. And let me know when you come up with an answer. That's other than the fact that we're preparing to go higher, because that is what we're getting ready to do. All right, that chart, though, by the way, this was a free chart that we provided to everyone in our Earnings Beats Digest community. If you want to become a subscriber, go over to earningsbeats.com and simply scroll down right here. No credit card required. You can unsubscribe at any time. No questions asked. 3 times a week newsletter. It's probably more value than you get from any paid service that you have subscribed to. Just try it out. Name and email address, hit that subscribe button. 3 times a week, usually just 2 paragraphs in a chart. Very simple. Today was an exception. I actually had 2 charts because I wanted to show this CPCE, what we had before and what we have now. We're in completely different markets. Beginning of 2022, we were very complacent. Everybody thought the market couldn't do anything but go up. So what did we do? We went down. Now we're in a market where we have extreme pessimism. Nobody believes the market can do anything but go down. And you know what? We're going to go up. It's the way the market works. It's the way it's always worked. But do you get a lot of this on CNBC? Of course not. First of all, they're not going to be optimistic because that doesn't sell. They need viewers. So they got to rattle everyone. That's number one. Number two, you've got these big Wall Street firms that prance on to CNBC telling you one thing. Their analysts are coming on telling you one thing. And then their market making unit back at the office is doing the opposite. You're buying and they're selling. Anyway, I'll just stop there. Well, it's 9:30. Let's let me just run you through a couple of these sector charts. Number one, do you realize that technology relative to the S&P 500, look at this run so far this year. We went up and tested the high that we saw back at the beginning of December of 2021, before this bear market began. Wall Street is moving into technology hand over fist. Those of you think we've got a big earnings recession coming, I'd like to know why technology is soaring. Please enlighten me. Consumer discretionary, back up above the 20-day. We had been looking horrible at the end, into the end of last year. Big rally to start the year. We pulled back. I said, watch for this to move back up. If we clear that February high here, I think discretionary is ready to go. Communication services already begun. I mean, it was the worst group by far for about 18 months. Well, maybe not quite that long, maybe 14 months, but it's changed. We've reversed. We're moving higher, relative PPO positive. We just broke out again on a relative basis. I don't care whether the S&P 500 is going down. Let CNBC talk about S&P 500. I care about what's happening below the surface. This is how you evaluate a stock market. It's not based on whether we go up or down. I think much more important is relative strength and intermarket analysis. I learned that from John Murphy many years ago. Get his books. I'd highly recommend them. Go over to Stock Charts, their bookstore, and read about it. It actually inspired me to do all the research I've done over the past couple of decades, and why I keep learning about the market and I keep researching, because I know there's a lot more to it than what they tell us on CNBC. All right, that's it. Let's see what the market's doing here. Fed announcement today at 2 p.m. I'm thinking we're probably going to be relatively flat. I mean, I don't see a whole lot before the announcement. And we know from history, once the announcement comes out, put your crash helmet on, get your seatbelt on, because we're going to have a wild ride. It'll probably be big up, big down, big up, big down. Oh, and I didn't show you, I do want to show you really quickly the negative divergence on the hourly chart, because this is the one thing holding me back, that thinking maybe the announcement, we're going to get one more pullback. Here's the 60-minute chart. Here are your highs, and there's your lower PPO. Now, if we were to play out all the way back down to the 50-hour moving average, that would take us down about 3% on the Qs. The recent low is at 302. That would be more like 2.5%. That is about the most downside that I see. We could go back down, but if you look at the spider, look at this, it's going up and the PPO is fine. Or the diamonds tracking the Dow, it's going up, PPO is fine. But then I look at something like semiconductors. Higher high, negative PPO. Maybe we go down one more time. So I'm thinking maybe in order to kind of iron all this out, maybe the Dow and the S&P outperforms for the next couple of days. And the NASDAQ kind of, with a rate hike, maybe money rotates out of the NASDAQ and back to the Dow, S&P. And maybe we really don't go down much, but it's just a little bifurcation. But I think after this is all settled and all done, I think your NASDAQ is where you want to be. I'm a believer in the QQQ. That's what I'm invested in. And if we do pull back, I told members, that's when I'm going to get out of some of my QQQ and I'm going to get back into some of the leverage, because I believe we are going to rally big into the earnings season. One last thing I did just want to mention, Nike reported yesterday. So Nike was down a couple of percent. Let's see where it's trading right now. Yeah, it's down 2.25% after coming out with its earnings. I believe it'll hold the 20-day. if it does get down there. And I think that's when we'll see some buyers coming in. All right, that's it for me. Listen, everybody have a great day. I'll be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. That will begin at 9 a.m. Eastern. Just come over at 9 a.m., click on this and hit the play button, and you'll be good to go. When you click on that, you'll see the video come up and you'll have a play button. And then you just click on that and you can listen in. Anyway, everybody have a great day. Let's see what happens with the Fed. It's going to be an exciting afternoon. Happy trading, everybody.